After earnings got released, Amazon dropped -4% on pre-market. So in this video, we are going to discuss about the results, see the most important thing about it and also about the conference call. And we'll do a valuation tour for the company to know on what the market is expecting in terms of growth and also if it can be an interesting buy or no. So since the results, the stock fall -40%, 4%. It depends when, but sometimes it's 2%, 4%. It's moving, and the year-over-year performance is still plus 40%, which is very good. In terms of growth, for Q4 2024, net sales plus 10%, AWS plus 19%. Okay, operating income plus 60%, and operating income for AWS plus 47%, and net income plus 88%. So very, very strong quarter. For the full year, net sales plus 11%, which is very good for a company which is already making a $600 billion in sales. Like still finding growth is kind of impressive. And AWS plus 19%. It's solid growth considering that they are market leader in the cloud and they continue to grow 19% per year. It's very stable. I think since the last 3 quarters or last 3 years, it's growing 19% per year, while we could see a decrease in Google growth for the last quarter and a little decrease as well for Microsoft in the last few quarters. Okay, so this is good. So as they're not decreasing, it's a growth which is less high than before for them. So the fact that Amazon stay flat on growth, 19%, 19%, 19%, is very good sign and shows some potential competitive advantage in the cloud on Google, Microsoft. Like they are not market leader for nothing. When it comes to operating incomes, plus 86% year over year, so very good. And AWS plus 61, almost 62% year over year. So operating income is really growing. It's very good. Net income plus 94% year over year. So almost double the net income during the year, which is also very good. And the operating cash flow plus 36% from 85 billion to 1116 billion. So again, a very, very strong growth. For the free cash flow, it's the part where you have way less growth, only plus 3.8%. So this is the problem, one of the problems that could explain why it didn't, it fall a bit after the earnings. But still, we know Amazon is not new. It's not really a company that will have a big, huge free cash flow because they invest a lot and they continue to invest. So generally, we'll mostly use operating cash flow to see if the investments are good or no, because they keep investing, they never stop. When it comes to margins, AWS operating margin in 2023 was 27%, 2024 it's 37%. So 37% increase, which is, this is really solid. Like it's a really solid point and it's very good. The global operating margin went from 6.41% in 2003 to 10.7% in 2024, 67% increase. We start to see operating margins that are very nice. Okay, Amazon, to be fair, it's one of the only companies that I have in my portfolio where I made an exception on operating margin. Generally, I want company with operating margins higher than 15%. Amazon is the only one where I accepted to buy at an operating margin under those 15% because it's really increasing fast. And as you can see, AWS, which is now $100 billion revenue per year, so it's one fifth of Amazon revenue, is really increasing and have good operating income and good operating margins. So the margin, I expect them to continue to grow, and I will not be surprised to see them around 15% in the next few years. For capital allocation, they had 85 billion in capex in 2024, and everybody was panicked with the 75 billion announced by Google for 2025 because the stock dropped 8% after the company announced $75 billion capex. So here, 85 billion, I'm not saying Google a little player compared, but it's still 10 billion higher and a year before. For 2025, and I think that what is explaining the stock drop is they expect $27 billion capex every quarter, not for the year, every quarter. So it's a bit over 100 billion for the year, for 2025. We should expect this. The CEO, okay, so Andrew Jassy, just said we don't procure capex unless we see demand. Okay, so this is important to note. They are in a situation where they have high demand and they need a lot of capex to continue to build data center, to build new ships as well. You will see that they have their own ships. So yeah, the capex is it too much? I don't know, to be honest, but they need it, and seeing the margin that they have on cloud, they can afford spending this because cloud and AI is something very important for the future. For the share outstanding, they continue to issue a new share on 1.5%. Not very good. I wonder when they will stop issuing new shares, but we will see. When it comes to guidance and conclusion of all of this, they are building their own chips, okay, and apparently they are 30% better than Nvidia when we compare to price performance, okay. They're still buying a lot from Nvidia, but as you can see, this information that they're building their own AI chips and they are 30% better than Nvidia, it's again decreasing the moat of Nvidia because it just shows that they are able to build their own chips. They don't need Nvidia's one. For now they need, because Nvidia is probably the only one that can bring that many for them, but they're able to do it. So if Amazon is able to do it, we could maybe not be surprised if Google, Microsoft may do them in the future. Okay, and it also can be another competition for Nvidia if Amazon start to sell those chips to other companies. So here, something you need to take care. It's not exactly similar situation, but something a bit similar happened to Intel a few years ago when the MacBook Pro, Apple, decided to do M1 chips. When they decided to do M1 and stop working with Intel, it kind of corresponds to the moment Intel started to really got fucked up on stock market and really start to get bad results. So you think you have a competitive advantage and then somebody start doing your job instead of you. So I'm not saying Nvidia doesn't have any competitive advantage. I'm just saying that take care because Amazon is able to build its own chips. So I don't see why another company will not be able to do the same. They have less fast growth expected for Q1 2025. Okay, here's the guidance. Net sales should grow between 5% and 9% for Q1, and operating income should be between 14 billion and 18 billion compared to 15.3 billion in Q1 2024. So we may have a decrease in operating income for Q1 2025. We will see, but this is, I think, the reason why the stock dropped also because of those guidance, which are not very good. I mean, 5 to 9% sales growth in 2025 for companies that big, I find it kind of okay, kind of good. The thing is more operating income. To not see an increase, I'm not a big fan. But at least they are not lying. They could just have say higher. The good news is if we are closer to 18 billion, I think it will be good. If we are closer to 18 billion, I guess the market could react positively for the next quarter results. But if not, if it's more next to 14 billion, it will be more difficult. They also seem to have the same problem than Google, okay, when they have a lot of demand, but they cannot give all what the market wants about this demand with this AI, AWS, and so on. So Amazon declares that they had a power constraint that slows the growth, and it should dissipate in a second semester of 2025. So we will see how it goes. So apparently, this capex can be justified because they have those power constraints. So after this, they will be able to give what the market wants, not have constraint on that growth, and can grow correctly because they will have less of those constraints and they could really give what the demand need, what the market needs. When it comes to valuation, we'll do two valuations, one with the net income and one with the operating cash flow, because some people think that analyzing Amazon with operating cash flow can be nice. So we needed the forward price operating cash flow for the average for the last 10 years, it's around 20, okay? And the forward P ratio average for the next 10 years, and for the last 10 years, was around 38. It's higher than 38, but I took out irregularity. So when it was like 75, 80, and so on, I took it out to have something more around rational area. So if we have a growth rate of 22%, okay? A PE ratio in the future of 30, and the price now, let's say it's $230. We could see a growth of 13%. If you want to invest in a company and your line to invest is 13%, for me, I don't invest if I cannot have CAGR under 13%. And now you can have 13% if you think that Amazon will grow 22%. Okay? Analysts expect the net income to grow more around 37%. Okay, so it gives almost 27% cumulated annual growth rate. So if you put 30% to have like 20% margin of safety, you have good. If you take 15%, you will have 6%. So I think 22% is achievable in terms of growth, and to have a PE in the future of 30 is also achievable. If you stay on the same PE ratios that we had in the past, so 38, you see you can have some very good growth. Now when it comes to operating cash flow, we'll do up. The operating cash flow here we'll put 20. So if you believe operating cash flow can grow by, to have 13% per year, to have 10% per year, you need an operating cash flow growing by 13%. If you think the operating cash flow can grow 13% per year, you can have this. Reminder, last year, operating cash flow during the year, 36% growth. Net income, 94% growth. So 13%, I think it's achievable, especially with higher margin that AWS is having. It's something very achievable, especially to a price of operating cash flow of 20. If you think it will grow higher, for example, 15%, you will have 12. You need 16% to have 13% cumulated annual growth rate. So a good price will be around $234 if you think you will have 16% growth rate for the operating cash flow. Here again, it's a forward. If you take not the forward, but the price operating cash flow for the last 10 years, it's more around 23. So here, same. You could have a good growth. You just need 13% growth to have 13% cumulated annual growth rate. So it's easy. If you think Amazon is able to grow its operating cash flow more than 13% for the next 5 years, year over year for the next 5 years, and the net income more than 22% year over year for the next 5 years, then Amazon should be considered as a good buy. Okay, it's in my portfolio, and I may buy more during the months or during the next months, depending on how the stock is going. So yeah, for me, it can be a solid buy. It's a price which is not ridiculous to buy if you believe in Amazon business model and if you believe in the company and in the people that are guiding this company to good results. So that's all for this video. I will be curious to know in the comment section what are your thoughts on Amazon, on the result. Do you think they are solid, not really solid? And also maybe what are the things that maybe I was missing during this video? Would be interesting to discuss all of this in the comment section.